Just when Canadians thought inflation was finally under control, dropping to 1.8% in February, the lowest in 9 months, a war 10,000 kilometers away is about to reverse all that progress. Gas prices have already jumped 15 to 20 cents per liter. Food prices are about to spike, and economists are warning that inflation could climb back towards 3% by summer, killing any hope of lower interest rates. Let me explain in plain English what's happening and what it means for your wallet. Welcome back to KP Money Talks, and today we're answering the question on every Canadian's mind. Is inflation coming back in 2026? The answer is yes, temporarily, and it's all because of the Middle East war. I'm going to explain why inflation dropped to 1.8% in February, why the number is about to jump back up, and most importantly, what this means for your mortgage, your grocery bills, and your savings. No jibber jabber, no economist speak, just straight talk. Hit that subscribe button and let's get into it. Let's start with the good news. Canada's inflation rate dropped to 1.8% in February 2026, below the Bank of Canada's 2% target for the first time since the last summer. Here's what drove it down. Statistics Canada released their data on Monday, and it looked pretty great on paper. Number 1. Grocery prices slowed significantly, especially for beef. Cell phone plans rose only 1.5%. The end of the GST/HST tax holiday creating a base effect that made year-over-year comparisons look better. Core inflation measures all dropped closer to Bank of Canada's 2% target. The CPI trim is down to 2.3%, the CPI median is also down to 2.3%, and CPI common down to 2.4%. Everything was trending in the right direction. The Bank of Canada looked like it might start cutting interest rates again. Canadians were breathing a sigh of relief. But there's a catch. This 1.8% number is a snapshot of February, and the Middle East war started on the last day of February. As Douglas Porter, chief economist at BMO, put it, this is really a snapshot of where the Canadian economy would be without the external shock to the outlook. The war's impact won't show up in the Statistics Canada data until the March inflation report comes out in mid-April. By then, Canadians will already be feeling it. Here's why economists are warning that inflation is coming back fast. Gas prices are skyrocketing. Oil prices have surged from $70 per barrel before the war to over $110 per barrel, a 57% increase. The Strait of Hormuz, which carries 20% of the world's oil, is effectively blockaded by Iran. In Canada, gas prices jumped an average of 15 to 20 cents per liter within 2 weeks. Some stations are posting $1.88 per liter in Montreal and over $1.68 in British Columbia. Douglas Porter warned that gas prices could skyrocket as much as 15%, driving headline inflation toward 3% in the coming months. Here's how economists calculate the impact. Gasoline makes up 3.71% of Canada's consumer price index. A 10% jump in gas prices adds roughly 0.37 percentage points to headline inflation. With gas up 15 to 20%, that alone could push inflation up by 0.5 to 0.7 percentage points, taking us back from 1.8% back towards 2.5 to 3%. But gas is just the beginning. The war has disrupted 30% of global fertilizer exports that transit through the Strait of Hormuz. Urea prices, the most common fertilizer, are up 30% in the past month. Canadian farmers are planting crops right now with expensive fuel and expensive fertilizer. Those costs will flow through the grocery store in 3 to 6 months. Jimmy Jane, chief economist, told BNN Bloomberg, if we recall in the Ukraine episode, we saw a big run-up in food prices, and part of that was due to the gas prices globally shooting higher. RBC Economics raised their headline inflation forecast for Canada to 2.4% average for the whole year, up 0.2 percentage points from their previous forecast. If oil stays at $110 per barrel, RBC warns inflation could peak around 3% in Canada by mid-2026. Here's where it gets really important for homeowners and anyone in debt. The Middle East war has completely changed the Bank of Canada's plan. The bank was done cutting rates. The Bank of Canada's policy rate currently sits at 2.25%. After 4 consecutive cuts to 2025, in early 2026, most economists expected the bank to stay on hold for the rest of the year, while inflation settled around 2%. Randall Bartlett, Deputy Chief Economist, said, "Ultimately, what we're seeing was the economy was weak, but not where it necessarily warranted the Bank of Canada to move interest rates in either direction. That was a plan. Hold steady, watch inflation stabilize, maybe consider cuts in 2027. Then the war changed everything. Now, the inflation threatening to spike back towards 3%, rate cuts are completely off the table. RBC economists say they're comfortable with their forecast for the policy rate to be held at 2.25% through 2026. Oxford economics and TD economics agree. No rate movements for the rest of 2026. Here's the nightmare scenario. If the war drags on for months and inflation climbs above 3.5%, the Bank of Canada might be forced to raise rates to prevent inflation from becoming embedded in the economy system. Bartlett noted that higher inflation would tilt the Bank of Canada away from needing more stimulative rate cuts, and potentially towards hikes if inflation gets out of control. If you were hoping to renew your mortgage at lower rates in 2026, the hope is fading away. Fixed mortgage rates are likely to stay around 4.5 to 5% for foreseeable future. If you have a variable rate mortgage, don't expect relief anytime soon. The Bank of Canada is staying put. Here's what makes this so complicated for Bank of Canada. They're facing conflicting economic signals pulling in opposite directions. On Friday, Statistics Canada reported that Canada lost 84,000 jobs in February. The unemployment rate jumped to 6.7%, well above pre-pandemic norm of 5.5% to 6%. The economy contracted by 0.5% annually in Q4 2025. GDP growth for all of 2026 is forecast at just 1.1%, barely above stagnation. Jimmy Jean warned, if we were to see more numbers like this on Friday, quickly you would start to see the R word, recession, being pronounced more often. Weak job growth and economic contractions normally call for rate cuts to stimulate the economy. But inflation is threatening to spike back up due to oil and food prices. The Bank of Canada's mandate is to keep inflation at 2%, and they can't ignore rising prices even if the economy is weak. This is what economists call stagflation. Weak economic growth combined with rising inflation, it's the worst possible scenario for central banks. Douglas Porter noted that the bank can look through temporary oil-driven inflation spikes, especially with unemployment rising and economic weakness evident. But if the war drags on and inflation stays elevated for months, the bank might have no choice but to prioritize fighting inflation over supporting growth. Governor Tiff McClim will likely address this tension when the bank announces its next rate. Economists are watching closely to see how he balances these conflicting forces. So what should everyday Canadians do about this? Here's your practical plan. Number 1. Lock in fixed rate mortgage. If you're renewing your mortgage soon or have variable rate, strongly consider locking in a fixed rate around 4 to 4.5%. Rates aren't going down anytime soon, and they could go up if inflation keeps climbing. Number 2. Budget for higher gas and grocery costs. Build a 10 to 15% buffer into your budget for transportation and food. Gas is already up 15 cents to 20 cents per liter, and grocery prices will climb over the next 3 to 6 months. The federal government is planning a grocery rebate in Q2 of 2026 for lower and middle economic households, which will help, but you still need to plan for higher costs. Number 3. Don't panic about temporary inflation. Oxford economics and most forecasts expect this to be a temporary spike. If the war ends within 2 to 3 months, oil prices should fall back down and inflation will ease by late 2026. The baseline forecast is that the inflation returns to 2% by 2027. This isn't 2022 all over again, it's a short-term disruption. Number 4. Keep cash in higher interest savings account. With the Bank of Canada holding rates at 2.25%, high interest savings account are still paying around 4%. That's a decent return while you wait out the volatility. Don't make major financial decisions based on short-term inflation spikes. Stay liquid and flexible. And number 5, consider energy sector exposure. If you have an investment account, consider small allocations to Canadian energy stocks, companies like Suncor, Canadian Natural Resources, and others. This provides a natural hedge. If oil prices stay high and hurt your wallet, at least your investment is benefiting. The bottom line is that yes, inflation is coming back in 2026, but it's temporary and driven entirely by Middle East war. Canada's inflation dropped to 1.8% in February, but economists warn it could climb back towards 2% by summer as gas and food prices spike. Bank of Canada is trapped between rising inflation and rising unemployment, and they're likely to hold interest rates at 2.25% for all of 2026. Lock in your mortgage rates, budget for higher costs, and don't panic. This shall pass. If this cleared up your confusion about inflation in 2026, hit that like button and subscribe for more Canadian analysis. Comment below, and I'll see you in the next one.